Okay, good morning, everyone. Welcome to Ducker Frontiers webinar, Navigating COVID-19 in Central America and the Caribbean and Post-Pandemic Landscapes. My name is Jamie Schaefer. I'm a Senior Manager on Ducker Frontiers Client Services team, and currently I'm based in Washington, D.C. in our company headquarters. We acknowledge that not everyone on the line is a current client, and before we begin, I want to take 2 minutes for a very quick overview of our company and who we are and how we support our clients. So Ducker Frontier is a global market intelligence and consulting firm for international executives. We have tailored solutions to drive growth for clients across the industrial, healthcare, consumer, and technology sectors. Our ongoing research paired with custom solutions and our transaction support services provide clients with timely and actionable insights so they can adopt and win in evolving markets. Our company is headquartered in Washington, D.C., with offices in Troy, Michigan, New York, London, Paris, Berlin, Singapore, Shanghai, Bangalore. For more information, please visit www.duckerfrontier.com. So with that brief overview, it's my pleasure to introduce to you our presenters, Ramiro Siguranes, Alejandro Valerio, and Lindsay Jagla and Mariana Zepeda, who are members of our Latin American research team and have led analysis that we're bringing to you today on CAMCAR. Before we jump in, I just want to mention that we do now have a mobile app, and you can download this both from the App Store and the Google Play Store, and we can share a link to do so after the fact when we share the presentation and the recording. So structure-wise, our session today will consist of a 45-minute moderated discussion, followed by a 10 to 15-minute Q&A. If you have any questions or points of clarification regarding any of the topics that we cover today, please send them to us via the Q&A box on the right side of your screen. I'll do my best to ensure that they are addressed during the final 15 minutes. So to get started, there's obviously a lot happening right now across Central America and Caribbean with significant economic and political challenges and a lot of uncertainty on the outlooks of these countries amid such a disruptive shock. We know that CAMCAR's economic environment has been completely reshaped by the coronavirus pandemic, as well as other regions and subregions across the world, and both from an internal and external standpoint, so generating unprecedented growth pressures from several fronts. But before we deep dive into this, I'd like to ask Ramiro Siguranes to briefly introduce the agenda for today and kick us off with a polling question.
Thank you, Jamie. And I think there's a lot for us to unpack there based on what you were mentioning, and we will aim to do that throughout this conversation. And I think my colleagues and I on the research team are very excited to bring to you all our latest insights on the region as companies continue to navigate the current pandemic and prepare for the future following the pandemic. So to lay out a little bit of the agenda that we have prepared for today, we're going to start off by explaining the framework that we're using to analyze the coronavirus shock across Latin America and how CAMCAR fits within this framework. Then we'll dig into the unique challenges that are more distinct to the region, followed by our economic forecasts. And then we'll also go deeper into some Central America snapshots across some of the main markets on the Caribbean side as well. And we'll close it off with business implications and actions to take that are relevant at the moment. And please feel free to send some questions, as Jamie mentioned, throughout the presentation, and we'll try to get to them at the end of the conversation, as many as possible. As Jamie mentioned, we do like to keep these conversations as interactive as possible. So we have a polling software that we use here, and for you to be able to use it and interact throughout the conversation, you can go to pollev.com/dfrontier560 on your mobile device. And we keep these completely anonymous, but it's a good way for you to be able to benchmark against your peers, how they might be performing or their expectations for the future, and have some comparative analysis there. So you do not have to input your name as you log into the polling software, but we would appreciate if you could state what industry you're in, and that way we can analyze some of the data later on an industry segment basis. So with no further ado, I would like to kick us off with the first polling question. And in case you need the information for participating in the polling, it is up here at the top, once again, at pollev.com/dfrontier560. But the first question we wanted to start off with was, by how much do you estimate COVID-19 will impact your revenues this year for the markets that you cover in either Central America or the Caribbean, or both, that is? And I'll give a moment here for everyone to get set up on the polling software. right, so starting to have some answers come in. It seems like the majority here falling in that 11 to 20% hit to revenues this year. As we were asking this question kind of earlier on in the year, there was a lot more diversity, I would say, in the kind of responses that we were getting and a lot more variation. And it seems like companies have become a lot more comfortable with predicting the kind of impacts that their top lines will suffer this year amid the coronavirus shock, and obviously some distinctions here across regions and across markets that different respondents might have responsibility over. So I will move on to one more polling question before we kick off, and that is, by which year do you expect your total sales in the Central American and Caribbean markets that you cover will return to 2019 levels? And this is a question that we'll try to answer more from the macroeconomic perspective of when we see some of the main economies across the region returning to those pre-COVID-19 levels of economic activity. So far it seems like we're seeing a lot of consensus around 2022. I think that aligns well with some of the major markets and what we're seeing on the economic front. But some a bit more pessimistic too into 2023 and 2024, and we will share our view there from the economic angle, as I mentioned. So with no further ado, to start us off here, I'll kick us off with understanding COVID-19 and the impact mechanisms and how we're analyzing the current situation. So there's going to be 4 factors that are going to be extremely important to understand the impact that the coronavirus shock is going to have on the economic landscapes of these countries and their trajectories and recoveries thereafter. So the first one's going to be the recurrence, the length, and stringency of social distancing measures. We know that these come with a large and significant economic impact, which is already starting to be felt across the region, across labor markets and firms at the moment. And then that leads to the second point here of how much our government's spending to try to mitigate the economic damage that comes with this social distancing measures and the economic pressures, right? This is going to be very important to gauge what governments can do to step in to try to mitigate how deep recessions are and also limit how much structural damage, which will be very important for recoveries to come. Then the third point here is all about the timing of treatment and a vaccine. Obviously, we're not vaccine development experts here at Dr. Frontier, but we are following the leading science on this and have some scenarios built around what we might see, which I will share. And then the fourth point is all about the political and social stability, right? We're already dealing with a trend across Latin America of some social unrest prior to the pandemic. And now with such deep and grave socioeconomic pressures being triggered by the current pandemic, we cannot rule out that we will see further disruptions or major shifts in the social and political landscapes too. So we'll try to touch a little bit on that. So to start us off on the first point of social distancing measures, we've adapted this framework from Tomás Puey's The Hammer and the Dance. And essentially, this is a good framework for us to think about how governments are currently confronting the coronavirus pandemic and different scenarios that we might see play out. And essentially, we can break this down into 2 phases. The first one is this hammer phase here, where essentially governments are trying to implement the most strict quarantine, lockdown, social distancing measures to try to flatten out the case curve of coronavirus cases as much as possible, to then go into what we call the dance phase. And what you're trying to do in the dance phase is essentially contain the pandemic at the lowest economic cost, right? So being able to open more and more of your economy without having those cases significantly spike or your healthcare system overwhelmed, or you have to re-implement a lot of the strict social distancing measures. But we know that not all countries in Central America and the Caribbean, Latin America are going to be able to dance the same dance, right? So we've identified a couple of dances here. One is this bachata slow dance, a bit more ineffective dance where we likely see more widespread social distancing measures being re-implemented, more economic damage. Or we have this samba, which is a faster dance here where you're able potentially to take more targeted social distancing measures, bringing a lower economic cost and getting more of your economy back online while containing the pandemic. Or of course, there's also the big downside risk, which we're hearing a lot about still, which is that potential big second wave, right? Having a second wave of cases that pretty much brings us back to that first phase where we have to implement a lot of the strict social distancing measures again, which we know would trigger even much harsher recessions this year and inflict more structural damage. So what are the key skills to stick with this dancing analogy that make you a better or a worse dancer or a slower or faster dancer? There's going to be 4 key points. First is how early did you react? How early did these countries start implementing border controls and social distancing measures? As we'll see across CAMCAR, most started acting boldly and early around mid-March. So there was kind of good timing there. But then another key point here is, are you dancing with the right tempo? And what we mean by that is, are you reopening your economy at the right pace, or are you risking doing it too quickly? And here we're seeing some divergences, with some countries in Central America being a bit more cautious and others in the Caribbean opening a bit quicker. The second point here is all about good information. This is extremely important when it comes to testing, especially, right? Because if we can do a lot of testing and we can identify where we're having outbreaks in a more targeted way, and you can recognize, for instance, that you're having a problem in a small neighborhood instead of an entire, then you can choose to lock down, for instance, just that small area instead of an entire municipality, entire city, an entire country, that is, and you can take more targeted and smart social distancing measures with more testing and have a better idea of the situation that is actually materializing on the ground to guide when you should be reopening too. And we know, of course, you can also do smarter measures such as case tracing, which was very important for countries in Southeast Asia and in Europe to try to get ahead of the virus. Then the third point here is all about healthcare infrastructure. Did you build sufficient capacity in your healthcare system during that hammer phase to prevent a collapse of your healthcare system if you have a spike in cases? And the fourth point is, do you have clear cohesiveness in the strategy and adherence from local leaders on the kind of guidelines that should be implemented from the social distancing front? As we know, there's a lot of conflicting orders. This creates a lot of noise and makes our social distancing less effective. So do you have a clear cohesive strategy there? And then also, we know that if you do have clear cohesive strategy there, people have trusted your kind of guidelines, and they might be more willing to go back to their normal economic activity while it's safe. And if they do not, the opposite would be true, right? They might want to stay indoors, still have fear, and we have a longer delay there before we're going into that new normal of economic activity. So to give us an idea here of where different countries stand from the containment standpoint and from their hammer phase so far, we can see that many countries in Central America and the Caribbean fall in a better group right now, right? Where we haven't seen the huge spike regulated per capita here compared to what we've seen in other major markets in the region. But there's still some countries that are showing a bit alarming trends, right? If we look at Panama, for instance, there's still a lot of uncertainties also in the Dominican Republic, Guatemala, which we have key concerns about as they start to move into that dancing phase, some of them without having sufficiently flattened their curve. And then, of course, there are some clear exceptions to countries that have surpassed and outperformed here so far in the terms of containment. And we see there Costa Rica, for instance, which is doing probably the best in the region as a whole, Trinidad and Tobago, Jamaica too, which have not seen those massive spikes yet and are entering that dance phase from a better perspective. To give us a brief idea here of what kind of measures were implemented during that hammer phase or the peak of measures compared to where we are now, we see that Costa Rica there, with better management, has been able to move more and more into that dance phase more effectively. Other countries in Central America remain pretty much with as many restrictions as we saw during the initial peak. So most of them there still with strict social distancing measures, as we continue to see some problems there with their cases continuing to rise. And then, of course, also in the Caribbean, as I was mentioning, we have moved more and more into that dance, but we haven't seen many of the case curves sufficiently flattened to give us enough confidence that there's not a lot of risk there. And I would say especially on the Dominican Republic front, because one clear caveat with those cases that I was showing earlier in the deaths per capita is that we have not seen sufficient testing, right? And this is a big problem for the Caribbean, because we might not have a full grasp of how bad those outbreaks really are. And really, if we look across the region here, the only market where we are doing, I would say, maybe sufficient testing to give us enough confidence in that curve that I was showing earlier in terms of either cases or deaths that are being attributed to coronavirus. Really, Puerto Rico is the one that stands out there, whereas the rest are really lagging in how much testing they're doing. So there could be worse outbreaks than we really see in the official statistics. And also does not give us good confidence that these markets are going to be able to move into that dance phase and take more of the targeted social distancing measures if they do face problems and have to rely more on some of those indiscriminate, widespread social distancing measures, again, which we know do cause a lot of economic damage. And one of the key factors to monitor here, which we know is a common trigger for governments to start implementing, again, these social distancing measures, is going to be on the healthcare capacity front, right? And especially here, the occupancy rate of ICU beds. As we can see, many of these countries, especially the ones that I was mentioning that have not flattened the curve significantly, have continued to see their ICU bed occupancy increase more and more. So for instance, Guatemala, Dominican Republic, or Panama here, where Panama City, as of mid-June, we had seen the city there hit about 90% of their occupancy rate. So that is quite alarming, right? And something that needs to be continuously monitored, I would say, by businesses too, as this is one of the important triggers that if the healthcare system becomes overwhelmed quite quickly, you might have to revert to a lot of those social distancing measures in many different places and start going into that dance. But in many cases, more of that ineffective dance, because we do have a lack of information too and a lack of testing, which would help to have more effective and less economically damaging dances, right? But all these countries are going to be in the dance for a while. And we know that during the dance, there is a lot of pressures towards structural damage of the economies across many different sectors. And governments are going to have to try to prevent that structural damage, right? Whether it be from the number of firms that go bankrupt in the moment or facing bankruptcy pressures, employment as well with so much job destruction as we have economic activity paralyzed for so long, or whether it be the business and consumer confidence story, the erosion of savings, all these things that governments have to try to interfere right now to try to prevent as social distancing measures last. But we know across the Caribbean and Central America that they are entering this crisis with very, very fragile fiscal positions, right? We can see here the majority of countries already having lost their investment grade a while back, entering this crisis with very, very challenging fiscal positions with their investment grades there in junk territory. And that is also guiding a lot of what they have been able to do in terms of stimulus. We know that currently their revenues are essentially taking a nosedive with economic activity coming to a halt and external and internal pressures on that front, leading many of them to have to run large deficits this year. And it's going to make a lot of those fiscal reforms very, very important after the pandemic, especially for countries where we're already talking about major reforms prior to the pandemic, such as Costa Rica, potentially, or Dominican Republic as well, where that is going to become more and more top of mind as we start to look at the post-pandemic world. Then here, there's also risks for other countries. For instance, Panama has been in a better position when it comes to its fiscal position, and that has been also reflected in how much it has been able to spend. But there are risks here too for Panama to maintain that fiscal sustainability, especially after the pandemic. We're going to have to see clear plans there being pushed and presented by governments that give confidence to investors. So to give us a bit of an idea here of how much we're seeing in terms of slippage of fiscal deficits for this year relative to recent historical values, we see essentially on this x-axis the average over the past 5 years of fiscal deficits, and on the y-axis the forecast for fiscal deficits this year. So most countries falling below this line, running significant fiscal deficits, which is really going to guide a lot of those fiscal reform conversations in the future and create a lot of pressure for these countries that are already facing challenges prior to the pandemic. As I was mentioning, they have a lot of vulnerabilities due to their economic models, especially given that they depend a lot on the external environment, and many of these in the Caribbean too, often facing the pressures of natural disasters. Then in Central America, also a similar story with many of them running high fiscal deficits this year. Costa Rica running another high fiscal deficit, especially in comparison to what we've already seen in terms of high deficits over the last years. That is going to be a key market to monitor on the fiscal front, as I was mentioning. Here we have an idea of what governments have been doing to try to support their economies now during this period of social distancing and quarantine measures. And there's vast variation across the region of how much governments are spending to try to support the economies. So on the far right side, we see countries that are clearly not being able to do enough at the moment, such as the Dominican Republic or the Costa Rica of the main markets, and others that are doing a lot more. Panama, as I mentioned, they're being able to act a bit more aggressively. Puerto Rico as well, especially benefiting from some of the federal funds that it receives by being a US territory. But a lot of divergences here, which are going to be extremely important to determine how much structural damage we end up having and what kind of recessions we also face this year, along with the success of containment. So to wrap up those two variables together, we've mapped up some of the main markets here on this framework, where you can see on the x-axis the kind of dance that we expect different markets to do. So Puerto Rico here and Costa Rica standing out as a clear markets doing more of that samba, more effective dance. And then we have the other ones in the bachata group, right? So Guatemala, Dominican Republic, Panama really having more trouble there, we expect, on the dance phase and causing a bit more pressure to their economies. And then of course, variations too onto how much governments are spending. And here we see some of them spending strong but insufficient. That would be the case for Puerto Rico and Panama, but the rest below, and in some cases quite low. And we do not see governments across the region really being able to spend enough to mitigate a lot of the structural damage that will come with the current pandemic. So to close us off here on the last couple of points that I mentioned at the beginning, the third component that's going to be very important means the timing of treatment and vaccine, especially for consumer and business confidence to start to normalize once we have a clear light at the end of the tunnel for the current crisis that we're going through. We know that the prior record for a vaccine being developed was 5 years with Ebola. Obviously, now with all of the global resources being put toward the pandemic at the moment, trying to find a vaccine, we're a bit more optimistic that we will get this across the region by Q4 2021 with moderate access. And why do we say moderate access? Because many of these countries do not have the industrial capacity to be able to produce a vaccine locally, which means that they're going to have to get in line essentially. So we see about 25% of the population being able to access it by Q4 2021. We have seen some positive headlines in the news recently that maybe this can come sooner, but this is our base case, especially given the historic precedent that how long it usually takes to roll one of these vaccines out globally, right? So that's still going to be very important for the confidence story once we get a vaccine, that we will have those investment and consumer behavior start to normalize more, but it'll still take a while to fully get into that new normal. And finally, the last point I want to mention here in this section is all about the political and social stability, right? So far, we have seen an interesting trend where governments that have acted more boldly in many ways have seen their approval ratings benefit at the moment. That would be the case, for instance, with the Alvarado administration, Yamate in Guatemala, or the Minas administration in the Bahamas. But those are not trends that are guaranteed to last, right? Especially as the social and economic pressures start to build more. We start to face the pressures of greater unemployment, of reduced purchasing power, reduced standards of living. All these things will build up again too, and there's no guarantee that many of these higher approval ratings will remain, right? The trend would actually be that you would expect, as those pressures build, to some of these to start to reduce or normalize a little bit more. And we have already seen the coronavirus start to play out in local political scenes across the region, right? So for instance, the recent elections in the PLD, where we saw the PLD being unseated, and although that was our base case prior to the coronavirus pandemic and the pressures that we were seeing built there definitely accelerated the trend and led to the sweeping victory of the opposition in the first round, which maybe would have been a runoff in a second round had that the coronavirus pandemic not been a key factor there. So the main point here being that there are key risks that we need to continue to monitor, and it will be important to follow a lot of these approval ratings as the pandemic evolves to gauge what kind of risk we might see from the social or political fronts and disruptions there.
Thank you, Ramiro. Super helpful. It's pretty evident that there's going to be significant divergence across CAMCAR, and some of the nations are going to fare better than others. But as a whole, though, it seems that CAMCAR is having relatively more success in containing the pandemic compared to some of its peers in Latin America. But still, structural economic damage, unfortunately, is going to be inevitable, leading to a slow recovery in a lot of the markets. But as I mentioned at the beginning of the call, we know that CAMCAR has other unique challenges at the moment that will still need to be confronted at some point. I'm sure that a lot of us are curious to know a little bit more about these challenges and how they're evolving amid the COVID-19 pandemic, especially to understand the risks that have surfaced, such as the impacts that the volatile and uncertain external environment is going to have on the region, but also how different markets are going to be able to recover from the crisis. Alejandro, could you tell us a little bit more about where CAMCAR was and where it's headed, but also what are the new risks and challenges that firms need to understand, both from an external and internal standpoint?
Thank you, Jamie. That's actually a really important question. And as you can see here in these slides, definitely the whole pandemic and how government actually has been dealing in terms of actually curtailing COVID-19, and then of course the economic shock has upended our drivers and changed it. And you can see here on the left side that although some of the drivers actually were pointing on a positive direction, like in the case of remittances and tourists, and they were supposed to help the countries across the sub-region, the situation now in the post-COVID-19, it actually has shifted, and it has shifted in a negative way. For example, in terms of global trade, we should be expecting that all these countries should be taking a hit in terms of actually the external sector. And exports, trade, there's going to be a lot of pain on that realm. Likewise, in terms of remittances and tourists and the high dependency on both of these drivers, it's going to be also affected because of the COVID-19 impact on countries that are really important for these markets, like the case of the US or the European Union. Likewise, one thing that is important that is going to have a mixed impact in the region has to be with the commodity prices. Some countries are going to be benefiting from low oil prices, but on the other hand, they're going to be affected because they rely heavily on other commodities like agricultural goods or mining. And the fiscal challenges, that goes to the point that Ramiro was making before. Not all the countries have the same fiscal capacity to respond to the depth of this crisis. So fiscal challenges are going to become more acute moving forward, and that's not something that is going to be affecting only in 2020, but it's a trend that we're going to see that having a major impact in the midterm and in the long term for some of these countries. And finally, in terms of internal demand, because of the rapid spike of the pandemic and the swift reaction that government have been taking, internal demand has actually been paralyzed across the sub-region. But moving forward, seeing this actually in a more nuanced perspective, you can see here in this graph the three key partners of the sub-region. The outlook has actually dramatically changed, and we have made a revision in the case of China from 5.9 to 1.3. And in the case of the United States, which is actually the key trade partner of the whole sub-region, we're expecting a contraction that is going to be worse than the 2009 recession, which was actually pretty bad, and it hit in a grand scale the sub-region. The same thing in terms of the Western Europe region, that we're expecting a contraction of -6% for this year. So putting it all together, all these countries now in a dire economic situation is going to be affecting external flows across CAMCAR. And in the case of China, that is an important key trade partner, and he actually has made a lot of inward in countries like Costa Rica or the Dominican Republic in trade relationships. Even though that is not going to be in contraction at this moment, definitely a substantial revision to his outlook put more pressure on the external demand of all these countries. And in the case of the United States, as we can see in the next slide, the main impact has to do in terms of the labor market dynamics. The impact of the COVID-19 has definitely upended the labor market and the health of the labor market, that it was particular in the US, that we saw unemployment at the lowest level in the last 50, 60 years, just a few months ago. But then has the COVID-19 impact on put economic activity on hold, we have saw a dramatically increase of unemployment, record numbers, like more than 30 million people unemployed, and double digits unemployment rate. And even though in June, labor market actually in the US started to improve, we have to be cautious with this trend because unemployment most likely is going to be ended in 2020 in double digits. And as you can see on the right side, the US is still struggling with the dance. And that has significant ramification for CAMCAR. Like, for example, in the case of Florida, which has become now the epicenter of the pandemic in the US, the contagion rate is actually quite high at this moment. We're talking about registering record numbers of active COVID-19 cases. In the last days, more than 30,000 cases have been registered. And that's actually bad news when we see that where the Hispanic population and where the remittances flows come from the US. It's the same thing in the case of Texas or California, that even though it was making progress, it has to roll back recently at the reopening of its economy. Moving forward, how actually translate for the region? And this is actually really important on two fronts. On one hand, as you see here on the left side, in terms of remittances across the region actually basically dancing the same pace of the US labor market dynamics, where the bulk of the Hispanic populations and immigrants from these countries actually are located. And you can see, for example, in March and April, when economic activity actually was halted in the US, remittances actually plunged on record number. In the case of El Salvador, that relies heavily on remittances, we saw that declining by almost 40% year on year in April. And then in May, we start seeing that, of course, in lower level, the decline, and in the case of the Dominican Republic, a positive trend. And that goes to the point I was making, that perhaps remittances are dancing at the same pace that the control of the pandemic in the US. For example, New York, that it was actually hard hit in the month of March, April, then in May, it started improving the situation, and that's and also in the northeastern states where most of the Dominicans are actually based in the US. On the other hand, in terms of tourist arrivals, which is really important, the origin markets from the tourist flows across the sub-region, they come mainly from the US, Canada, and the European Union. And as all these countries have to take measures to curtail COVID-19 and to avoid transmission of the virus at community from community, they have to shut down their airports and they have to shut down their tourist facilities. And that's why we see that this major decline in the month of March and April. And likewise, we're not expecting a huge recovery in this industry because of the major impact of the pandemic on the labor markets of the markets of origin from these countries. Moving forward, like I pointed out at the beginning of this part, one thing that is important in terms of commodity prices is that on one hand, we're going to see some countries benefiting from low oil prices, like the case of Costa Rica and Dominican Republic, which are set to benefit in terms of balance of payment, maybe saving between $900 to $1 billion in terms of payment because they are net importers of oil, like basically all the countries in the sub-region. But then on the other hand, we're going to see that the external demand of these countries are going to be affected with weak agricultural products prices declining, and the same thing that the impact on the extractive industries, which in some countries are actually quite relevant. Countries that were poised to make substantial revenues on that front, like the case of Guyana, with the recently oil fields that they were tapped in the last couple of years, they're not going to benefit like they were supposed to benefit because of low oil prices and commodity prices overall. Moving forward, to summarize this part, I think this slide is really important. When you start thinking about all these countries and how all these trends are affecting across the sub-region, here you can see in this chart something that is really important. On the axis, countries that rely heavily on remittances as percentage of GDP, like the case of El Salvador or Haiti, they're going to be the second one to recover. And they're contingent to the US labor market rebound. On the other hand, and that has to do what you see that on the y-axis, countries that rely heavily on travel and tourism and industries that are going to be hard hit because of the pandemic, it's going to take a while to recover, like in the case of Belize. And the countries that are set to recover faster are the ones that rely heavily more on exports. And that has to do when we see that the US and the EU actually going back online where most of their products are going. And the same thing in the case of some of these countries like Costa Rica, that they have increased their trade with countries like China, that they're also going back online soon.
Thanks, Alejandro. So my take really from this is that a lot of our clients and all of us, especially those in the CAMCAR and Caribbean region, are going to have to deal with an unprecedented level of uncertainty and economic pressure in the coming months, but also in the next couple of years. I do have one question for you, though. So now that we saw the growth drivers and the risks associated with the region, how do you think this is going to materialize in terms of contraction and recoveries for the economies? And how do you see variations applying across industries as well?
That is a great question, Jamie, as well. And you can see here that perhaps the worst already happened. The biggest contraction across the sub-region will be in Q2 of 2020, but we should be expecting a rebound now in Q3. Of course, it's going to be different across countries, and as you can see here in this graph, Panama and Guatemala are poised to recover faster, like in the case of Dominican Republic and Puerto Rico, which will have probably the worst contraction across the sub-region. In terms of industry verticals, and that's actually really important too. That goes with the first polling question we did in terms of actually revenues. As you can see here, that is quite divergent and it's quite different. For example, retail, fast-moving consumer goods, they're supposed to be doing better. They should be, normalizing at pre-COVID-19 level by Q4 of this year, and that has to do because since everybody went actually on a lockdown, appliance and goods like food, beverage actually were in high demand. On the contrary, as you can see on the bottom here, hospitality, tourism, and leisures, like services, for example, on that front, they're going to take a while to recover because of, on the one hand, we see the decline of that sector across the globe. On the other hand, because of the domestic measures that governments have to be put in place to curtail COVID-19. And one thing that is important, IT and telecom, all the companies that want to continue to perform, they have to revamp their infrastructure in terms of technology, because this is the new normal, and that's something that is going to be here for a while. But now we would like to hear again from you, and this is another polling question we have. When do you expect sales to start to pick up in the markets that you cover in Central America and the Caribbean? Okay. Q3, Q4, 2020. Not until 2021. Give a few more seconds. Overall, it seems like the consensus is actually not until 2021. Okay, I think we got a sense. Just to summarize this part, this is one thing that we want to leave you, that most of the major markets in the Caribbean, they definitely will take longer to recover vis-a-vis Central America, particularly in the case of Puerto Rico, that we expected that is going to continue to have problems, like my colleague presented on the past, in terms of fiscal challenges. And Panama, Guatemala, and Costa Rica, they should be compared to where they were before the pandemic hit, and by the end of 2021 in terms of GDP.
Thanks, Alejandro, especially for providing the quarterly forecast for some of those key markets. It's going to be interesting to hear more specific views on some of those main markets, though, in Central America and Caribbean. Mariana, could you briefly walk us through the main outlooks for Guatemala, Panama, and Costa Rica, and what you're seeing as key growth drivers and risks for each of those markets, respectively?
Sure, thank you, Jamie. So as we have discussed, country outlooks have significantly shifted. However, there are unique factors in each country that will impact the depth of current contractions and the country's abilities to recover. So starting off with Costa Rica, although Costa Rica has managed the spread of COVID-19 well compared to its regional peers, the country's efforts have come at a cost, and we expect Costa Rica's economy to contract by 3.6% as COVID-19 hits the country's key economic sectors. For instance, tourism is key to Costa Rica's economy, and it accounts for about 13 to 14% of GDP. The industry has collapsed given border closures and the overall hit to the global tourism industry. But as countries with major tourist flows to Costa Rica, such as Canada, the US, and some European countries, begin to recover, tourism is likely to slowly increase. But it'll take some time for it to return to 2019 levels, and we don't expect a full recovery in 2021. Manufacturing is also a key part of Costa Rica's economy, and exports were hit hard as Costa Rica's main commercial partners, which include the US, China, and Europe, suffered the economic blow from the pandemic. And as these partners begin to recover in Q3, exports are likely to grow again, with Costa Rica's manufacturing industries recovering and returning to a growth trajectory around 2021. Additionally, retail and consumer services were hit especially hard by COVID-19 because Costa Rica implemented strict social distancing measures. Unemployment was already pretty high. It started the year at around 11% and has continued to rise during the pandemic. So despite the government's fiscal stimulus, job recovery will be slow, and consumption will take time to recover. Something important to note with Costa Rica is that even prior to COVID-19, Costa Rica's biggest challenge was its rising fiscal deficit. And although President Alvarado has been able to continue borrowing because declaring a state of emergency allowed him to set aside Costa Rica's fiscal rule to cushion the blow of COVID social distancing measures, it's politically unlikely that he'll be able to continue down this path for much longer. As soon as H2 2020, Alvarado's administration will have to take steps to tackle the deficit, likely by cutting public spending, which will not be easy. Costa Rica closed 2019 with a fiscal deficit of almost 7%, and it's entirely possible that it could reach double-digit deficit by the end of 2020, which would further threaten its global investment position. So overall, Costa Rica has handled COVID-19 successfully, but the country will be paying a high economic price. So moving on to Panama. As COVID-19 weakens global trade and investment, Panama will see a recession as well, and we expect its economy to contract by 2.2%. In Panama's case, we anticipate a strong rebound in 2021, largely driven by mining and canal revenues. But Panama's economy does rely heavily on its construction sector, which accounts for around 16 to 17% of the economy. However, construction was largely on pause while there were quarantine measures in place, and the private construction industry doesn't yet have a confirmed timeline for full reopening. So recovery will be pretty slow into 2021 as the pandemic hampers investment. But Panama does have two key economic sectors that are likely to help in its recovery. Firstly, Panama has a booming mining sector, particularly following the opening of Cobre Panama, which is expected to contribute around 3% of GDP. And although the mine had to temporarily shut down after a COVID-19 spike, as commodities start to slowly recover, production of gold and copper will help boost Panama's 2021 recovery. Though, of course, the risk that another wave of COVID will hit the productive sector remains. Additionally, the Panama Canal is a really important source of income for the government. Canal revenues are likely to rebound around Q3 or Q4 as global trade improves and as we see recovery in the Chinese and US economies, which account for almost 80% of the revenue collected from canal transit tolls. So though rebound is likely to be steady into 2021, Panama will have to cope with sluggish investment as well as higher debt due to the increases they've implemented in COVID-19 related spending. And the Cortizo administration may have to continue putting its reform priorities and its plans to boost infrastructure spending on pause. So finally, in Guatemala's case, we anticipate a 2% contraction as COVID weighs heavily on tourism, trade, and remittances, as Alejandro discussed, depressing domestic economic activity, which only adds to the hit the economy has already taken by the quarantine measures the government implemented. So Guatemala is highly dependent on exports to the US, Mexico, and other countries in Central America. So recovery is likely to hinge on how long it takes Guatemala's commercial partners to recover. And although agriculture exports have not been hit quite as hard as manufacturing, we do expect both sectors to start to normalize and continue growing in 2021. Along with the social distancing measures, the fall in remittances and exports that we're already seeing will weigh heavily on internal demand, affecting retail and consumer services. But remittances are expected to recover on the back of US labor market recovery. And since President Giammattei is highly committed to maintaining strong US-Guatemala relations, we expect remittances to continue flowing into Guatemala, strengthening consumer spending. So though Guatemala's externally driven growth drivers could help the country recover more quickly than others, Guatemala will be especially vulnerable to changes in US policy. As Alejandro discussed, remittance flows could be affected if there is another round of closures that increases US unemployment, particularly in the services sector. So it'll be important to keep a close eye on the US labor market. And Guatemala's governance issues will continue to threaten economic activity and could hamper the country's ability to recover quickly.
Thank you, Mariana. Having those nuanced views is going to be very imperative for firms to understand each of the market's ability to cope with current shock, especially what the drivers and restraints on the economies are going to be. Lindsay, do you think you could walk us through a similar review for Puerto Rico and the Dominican Republic?
Of course, I'll jump right into it, starting off with Puerto Rico. So prior to the COVID-19 shock, Puerto Rico was already struggling due to its persistent structural issues. Puerto Rico's primary difficulty is its increasingly unsustainable debt, which is driven by its peculiar status as a U.S. territory, a poor tax system, and high spending, especially due to significant social transfers, not to mention the population decline and increasing risk of natural disasters that continue to plague the island. Limited access to disaster relief federal funds has exacerbated these issues and will be a key factor in the island's recovery post-COVID-19. Before the virus outbreak, Puerto Rico had begun major debt restructuring negotiations. These have since been halted, with the government delaying any spending cuts for a year. So the island's lack of fiscal consolidation will limit the island's fiscal capacity in the long term and force it to rely even more heavily on these U.S. government funds, which are politically volatile. This is especially true in the construction sector. So growth in this sector relies heavily on federal funds for reconstruction. Declines in the sector directly tie to subpar federal funds received by the island, which we continue to expect to be the base case. Puerto Rico has also become less competitive from a manufacturing hub standpoint. Unless new sustainable tax and regulatory frameworks are created for key manufacturing industries following the pandemic, it is likely that the trend of falling manufacturing investment continues. This is especially difficult because it depends on a sustainable solution from a local and federal standpoint that also accounts for current debt dynamics. For this reason, although we see some of Puerto Rico's key economic sectors recovering next year and an initial economic rebound in 2021, we still expect persistent structural issues to stunt its overall GDP growth. So as you can see on the graph, we expect GDP growth to fall below 1% year over year, both in 2022 and 2023, and returning to its over a decade-long recessionary trend. This is also supported by the fact that the tourism industry will be the slowest to recover globally, as my colleagues mentioned. By 2021, we expect the tourism sector to have stabilized, but we do not expect a quick acceleration for the industry. So overall, we remain pessimistic about Puerto Rico's long-term growth outlook. The Financial Management and Oversight Board recently announced plans to address the island's structural issues. In addition to tax reforms that seek to increase government revenue, the reforms primarily focus on making the island more attractive as a place to do business. Many of these reforms remain politically difficult, however, especially those that impact Puerto Rico's social spending, which is traditionally pretty high. These reforms are also going to be difficult from the standpoint of Puerto Rico being a territory and having to work with the federal government on many of these issues. So without the successful implementation of these reforms, debt negotiations will continue to falter, and many of Puerto Rico's structural issues will remain unresolved, preventing noteworthy economic growth. So with that, I'd like to transition to the Dominican Republic. So in contrast to Puerto Rico, the Dominican Republic had a more favorable outlook prior to the COVID-19 crisis. However, much of the country's growth is driven by external factors, primarily through foreign direct investment, tourism, remittances, and exports, which have been severely impacted by COVID-19. As the external environment improves, we do expect some pickup in the country's key economic sectors in 2021. Like Puerto Rico, one of the clearest economic sectors in the Dominican Republic impacted by this negative external environment is the tourism industry, which, as I previously mentioned, will be slow to recover and will not be a growth driver in 2021. Other sectors in the Dominican Republic will prove slightly more resilient. Construction will receive a boost as foreign investment picks up, and a focus on public-private partnerships will help the industry receive funding regardless of government spending capabilities. Retail and consumer services will also receive a boost from normalizing economic activity. Additionally, at the same time that the domestic economy begins to reopen and improve employment conditions, the island will also begin to receive greater inflows of remittances as the U.S. labor market also recovers. Despite these sector-by-sector improvements in 2021, the island's overall growth will not return to pre-COVID-19 levels in the next couple of years. We expect slower growth to stem primarily from the country's fiscal situation. The Dominican Republic has consistently run fiscal deficits, and over half of its rising debt is external. And now significant peso depreciation will make financing its debt even more difficult. The incoming government of Luis Abinader will have to deal with the increasingly unsustainable debt situation, likely with a substantial tax reform following the pandemic. Other structural issues will be important for the government to address in order to boost growth. including high levels of economic informality, as well as corruption and clientelism. One favorable aspect of the Dominican Republic's economy is its policy continuity and business-friendly politics, which we do see continuing following the recent elections. But still, we do expect the Dominican Republic's economic growth to be muted by a slow global recovery overall and the continued risks due to its weakened fiscal position. And with that, I'd like to turn it back to Jamie.
Thank you, Lindsay. So moving into my last question, given a lot of the uncertainty about CAMCAR's new normal and the tremendous pressure that firms are currently facing, I'd like to turn my last question to Ramiro about what actions firms can be taking when it comes to their CAMCAR business, not only in the short term, but also in the long term, which is arguably going to be just as important.
Sure, Jamie. I think there's key differences there that firms need to be thinking about at the moment as we go through the short to medium to long-term actions. In the short term, to start us off here, I mean, obviously the greatest priority is going to be protecting employees during the current pandemic, but also promoting business continuity, right? And anything we can do, leveraging digital solutions at the moment to promote that continuity, working with our partners on that front too. It's going to be very important, right? And then another key thing here is going to be protecting cash. Obviously, this is very top of mind for firms right now as we go through the crisis. And this is going to mean looking back at how we're managing our working capital at the moment, making any reductions or delayments of CapEx or OpEx will be key too to consider as we continue to weather this storm for a bit longer. In the medium term, I would say the key point here is all about forecasting the timing, the speed and the magnitude of markets when they start to rebound, so making sure that our teams are prepared on this front, that we're aligned and ready to execute once we start to have demand start to pick up again in the market, making sure that our supply chains are ready for that market rebound. And that's going to be the main priority there. And then in the long term, we know that after going through a massive shock like this, many things will not go back to normal once we go into that new normal. We need to be prepared for that, and we need to be thinking about the ways that we can currently even be reshaping that new normal to make sure that our business can benefit from it too, right? So this is going to be everything from going back to the drawing board and resetting our long-term strategies and our key initiatives, making sure that we have strong alignment in our companies with these new initiatives from the top to bottom, across geographies, across functions, and then also making sure that we have a strong scenario planning approach to the future, right? We know that the current pandemic was a bit of a black swan event, but we know that we're going to get more surprises in the future, more disruptions, and we need to ensure that we're prepared for those as we move forward to not be caught significantly off guard, right? So those are going to be all different ways, and there's some other ones here that I haven't touched on, but we'll make sure to send the presentation to all the participants today so you can digest these with more time. And what I would like to close off of here on this section is I know our outlook has been quite pessimistic, and I want to make sure that we end on a more upbeat and opportunistic note looking forward, because there are a lot of opportunities still across the CAMCAR region that firms should be thinking about right now, right? So whether it is leveraging the low valuation, especially with some of these markets that are having FX pressures, to take advantage for inorganic growth in the moment, revisiting our supply chains given disruptions that may have been confronted in the pandemic right now and pushing more for localization. Key important one here that we've seen many firms focus on is adapting their value propositions to customer behaviors, new customer behaviors following the pandemic, as we know there's going to be key changes there too, or other ones that have been very top of mind, things like rethinking the office space, and of course accelerating the digital transformation that we've seen and is going to last after the pandemic too. So now I'd like to just close this off with one final polling question before we take questions from the audience, and that is, where do you see the biggest business opportunity for your company in Central America and the Caribbean? And if you do have any questions, I will send a reminder that you can send them through the chat box there. We'll make sure to address those. All right, so far, I think we're seeing the common trend, which is that accelerating digital transformation and adapting the value proposition to new customer behaviors following the pandemic are really the two main points that we've seen companies focus on, and what I would expect to see too for the CAMCAR region. So now maybe we can open it up to questions from the audience, and anything here across any specific markets, we'd be happy to take. Great.
So Ramiro, looks like we received one question already. One of them is, do you think the current pandemic is going to lead nations in the region to try to diversify their economies more? If so, how will they go about doing so?
That's a great question, and one that's, I think, very difficult to answer in a way that it's creating a lot of challenges for these governments to confront at the current moment, right? We're talking about a region that is so externally dependent and has so many vulnerabilities from that externally dependent economic model, and also from, let's say, for the instance of the Caribbean, especially being vulnerable to natural disasters, things that can often throw off their economic performance or fiscal situation. And this has been yet another shock that has, pressed those vulnerabilities further and showcased those at the moment. So I think it's going to be very difficult to do that transition in the short run, but at this moment does create a key opportunity for governments to push reforms that are very different and much deeper structurally after going through such a massive shock like this, to try to encourage that diversification, right? Especially to push towards more value-added, I would say, industries in their economies, and more development of those manufacturing sectors, not having so much reliance on tourism and exports through potentially different incentives, especially as tax reforms, fiscal reforms start to be debated again across many of these countries. That will be extremely important. And with the digital transformation trend that we're currently seeing too, that can be something that many countries can leverage to, make productivity gains and also diversify their industries a bit more as we look into the future.
Thank you, Ramiro. We received another question, which I thought was rather interesting. So what kind of implications do you think the US election could have for the region?
So I can hop in here, and Alejandro, if you want to.
Sure. I think this is really important question. Of course, it has a lot of ramifications for the region, particularly if regarding immigration policy. If President Trump is reelected, we should be expecting, more hardline immigration policy, and that could have implications for the region, particularly for Central America, in terms of remittance flows. Unfortunately, many of the Hispanic populations here, they amounted or the amount for the bulk of undocumented workers, and that could have a repercussions. I think if a Democratic administration wins, or Joe Biden wins particularly, the free trade agreements that benefit the South region, like the CAFTA DR, it will remain in place. And perhaps we should see that a more pro-immigration reform administration, that it could help to legalize the bulk of undocumented immigrants in the US, which it could redund in terms of remittance flow continue to be on the high end moving forward.
Thank you, Alejandro. So we're right at the hour. I just want to thank everyone for your questions and your time this morning or this afternoon, wherever you might be, especially to Alejandro, Ramiro, Lindsay, and Mariana for putting together such a powerful presentation today. I think this shed a lot of light on some of CAMCAR's unique challenges and what we see for some of the main markets moving forward, not only the rest of this year, but also into 2021. As a reminder, there are questions that we weren't able to answer on the line today. We'll follow up with those responses via email through your relationship manager over the next 24 hours. But we will also send you a link to the recording, as well as the presentation that we made here today. So thank you again for everyone who joined us. We look forward to speaking with you again soon, and stay well and stay safe. Thank you.
Thank you all. Take care.
Thank you.